Hi there, I'm Tim Clairmont. This is Clear Money Talk, where we turn complex financial topics into clear, actionable, practical insights.
And I'm Tyler Andrews. Welcome to the show. Our topic of the day is private equity worth the hype?
This is going to be interesting.
Initial thoughts, Tim.
So private equity, actually I heard a statistic recently that was pretty phenomenal. The biggest companies, in the world, the largest companies in the United States that are publicly traded only represent about 13% of the wealth that's out there in terms of, these large companies. Now, I don't know, again, I'm re-quoting a statistic from somebody else that quoted a statistic, so I'm sure we'd have to verify the accuracy of that. But the implication is that 87% of the wealthiest entities that are out there are privately owned, meaning we can't own a piece of them in our portfolios unless we have some opportunity to own private equity. And there's a very limited selection of ways to do that. I think it is worth the hype in terms of the opportunities that exist out there, assuming that there's accuracy in that statistic. Just because there is a lot of additional companies that we just can't participate in their profitability and their growth without considering the opportunity to include private equity. That being said, the lack of liquidity on private equity positions is really significant and very critical when you're dealing with a lot of clients that need to have money at random moments in time, and they may not have as much access to things if there's not a public market. It's probably worth talking about what private equity is. There's a lot of people out there.
I was going to go first with this.
That probably makes sense. So anyway, nerding out.
Love getting your initial thoughts on this, Tim. It always kind of sets the tone for the podcast, which I appreciate. But sure. I think talking about what private equity is, we could start with that. It gets thrown around so often. It's like, I work in private equity, or I know somebody that works in that sector, or my buddy's investing in private equity. And it's like, what does that mean at the end of the day? So I thought this would be a fun podcast to share our insights and see where this thing takes us.
Yeah,
so
that's great. Let's just go with some quick basics.
Yeah. The gender, you already hit on it, Tim. Private equity is investing in private companies. So companies that don't have a ready market, anything that isn't publicly traded on an exchange. It's usually investors pulling their assets together in a syndication, if you will, to purchase private companies. And like Tim mentioned, it's highly illiquid investments. There's usually different holding periods assigned and associated with the different investments private equity is making, as well as lots of different ventures that private equity take. There's different sectors of the economy certain companies focus on, and a lot of the times we can get into the pros and the cons and who it makes sense for and who it doesn't make sense for. But I think an analogy is a great way to go into it, Tim.
Sure.
To talk about.
You have one in mind?
I do.
Let's hear it.
It's a lemonade stand. So
all right.
I want you to sit back. I want you to close your eyes, and I want you to imagine that you are a young buck again, and you're running a lemonade stand in your neighborhood. And the lemonade stand's doing okay, but you're running into certain constraints. Maybe you have a lot of customers, but you can't serve them all. Or you run out of lemons too quickly in the day, and then you have customers come by that still want lemonade, but you're out of your supplies. And then I want you to assume that some other nice kids in the neighborhood notice your lemonade stand. They say, you know what? I like what they're doing down the street. I want to help them. And instead of working for them, I want to take some of my allowance, and I just want to buy their lemonade stand from them. And the kids, pull their money together. A couple of kids on the block, they buy your lemonade stand. And then what they do is they're going to take maybe a loan from the bank or a loan from their parents in this situation, and they're going to improve your lemonade stand. They're going to maybe find a better supplier for sugar, maybe cheaper than what you were paying for previously. They might find a better supplier for lemons, so that way you're not running out of lemons throughout the course of the day. And their total plan for this is to increase profitability, gain new customers, and at the end of the day, sell it for more than they purchased it for, and harvest the profits assigned with that. So it's kind of a kiddie way of looking at it, but sometimes taking the extra complicated and numbing it a little bit down to the most simplistic case is helpful for me, and I hope it's helpful for you. But
okay,
what are your thoughts?
I love the analogy.
Yeah.
So the first thing I have to say is I'm getting completely distracted by the comment "young buck." It's okay if it's a young doe. You don't have to be a young guy again. You could be a young gal, or however you identify, of course. But at the same time, as I go back and reflect, I feel like the analogy is an excellent one to describe how venture capitalists invest in a firm, and a private equity is an example of the fact that lemonade stand because ownership of the lemonade stand isn't publicly traded on a stock exchange, it makes that lemonade stand an example of a privately held company.
Yes.
And as a privately held company, I think your example of how venture capitalists might choose to invest in that lemonade stand and then affect ultimately at the end of the day, it's kind of like Shark Tank. I mean, if you watch Shark Tank, it's along those lines. These are investors that want to buy in and they want to tweak that investment strategy, and then they want to be able to have that strategy be worth a lot more money. And frankly, many of the investments that come on Shark Tank, if you look at that kind of concept, they're small private equity investments. They're not publicly traded companies. They're all bringing their lemonade stands to the sharks, and then the sharks got to decide which one they're interested in. And if they're interested in it, they lean in and they get the better lemon and they get the better sugar and they get the other suppliers, and then they increase the value of that. And so I think that's really, really key and helpful. But there's a lot of things about just trading on exchanges and equity in general that I think can be confusing to people. So I want to just hit that from a clarification standpoint. When you hear the word equity, I just want to make sure that you understand that's synonymous with stock. So when you own stock in a company, you own part of that company. That's what equity means. It's the shares of ownership in a company. And when you hear the word New York Stock Exchange, that is just an example of a place where you can buy and sell shares of stock. So if you own stock in IBM or Coca-Cola or Microsoft or whatever, right? You can just buy or sell those. I'm dating myself with IBM, but you can just buy or sell those things on the New York Stock Exchange. Well, to get listed on the stock exchange, the New York Stock Exchange, you have to be a really big company. There's a certain threshold for size. And the rules for big enough company to be listed on the New York Stock Exchange are a little bit different from the rules about the American Stock Exchange, which is another place where you can trade trade securities. There's another one that was commonly referred to as the NASDAQ. You may have heard of the NASDAQ before. What the NASDAQ stands for is the National Association of Securities Dealers Automated Quotation System. So that was previously a place where smaller companies could go public or have an IPO, initial public offering, where they then make their stock available to be purchased on a public exchange, but they weren't big enough companies to list on the New York Stock Exchange or the American Stock Exchange. So instead, they would list on this automated computer-driven stock exchange called the NASDAQ. And that's what those are. So those are just places to buy and sell individual stocks. What we're talking about when we talk about private equity is we're talking about all those companies that are owned by people that are not trading their stock on any of those exchanges. You can't just buy or sell the stock in and out of every second, on the exchanges, because they're not eligible, or they're choosing not to, even if they are eligible, list their stock on those exchanges. And what that means is that there's no ready market. If you buy the stock because you have an opportunity to buy one of those lemonade stands or one of those things on Shark Tank, and you are like, oh great, I own 5% of this really cool company. Well, then 2-3 years from now, you might be like, hey, I really want to get my money out. Looks like the company's doing pretty well. There's no buyer. There's no exchange. You can't just take your stock and say, hey, New York Stock Exchange, what's it worth today? It doesn't work. You have a privately traded stock in a company. You have to go find the buyer. You have to go find, and because it's so illiquid, the buyer is probably not going to be willing to pay full price. So they're only looking to grab your stock if it's a deal. And if you're just one small owner in this big, huge entity, the lower the deal, the prices that you're going to get. Sometimes there are things called liquidity events. All that is a moment when somebody like the venture capitalist, the Shark Tank individual, comes in and says, hey, I want to, we're going to go ahead and have this huge purchase. And at that time, that might be an opportunity for some of the owners to sell some of their stock to that new venture capital investor or whatnot. But yeah, is there hype? Yes. Is it complicated? Sure, it's a little complicated, no matter how clearly our analogy is communicated to you. It's a little complicated, but most significantly, it's not as liquid, and that lack of liquidity, has a tremendous impact on the how easy it is to make money in the private equity area, which is to say, it's not necessarily easy.
Yeah, I'm just still hung up on how nerdy you are when you actually took NASDAQ from an acronym to what it means. That's amazing.
Yeah.
National Association
of Securities Dealers Automated Quotation System. Yeah, I've been doing this since 1997, man. Back then, NASDAQ was a thing. Of course, New York Stock Exchange was a thing too, and then they combined them all together and have this whole thing like FINRA and all this other stuff. Anyway, the point is there's a bunch of these acronyms. And there's a bunch of consolidation that's occurred in the last 30 years and a lot of these things. But when you hear New York Stock Exchange, when you hear American Stock Exchange, when you hear NASDAQ, those are usually terms that many of our clients have heard before. Mm-hmm. And even if those are now conglomerated in various capacities and convoluted in terms of, what they were originally designed for and what they're actually doing now, it's still a good baseline to understand. It's just a place where people buy and sell stocks.
Yeah. Let's use that as a good natural pivot, Tim, to talk about why it's gaining attention, maybe more so than ever these days.
Yeah.
We've got a couple bullet points. We can maybe each share some thoughts on each of them and
love it.
Keep on going with the podcast that way. One of the large reasons public markets feel crowded these days. So I think with a lot of high valuations for many of the public companies out there right now, we're seeing PE ratios, in the high numbers more so than ever. Finding value in existing public companies is harder than ever, and just feeling like the markets are constantly a moving target for many investors can push a lot of people to want to look to other areas to deploy their capital, their cash for trying to get rate of return and opportunities there. And so, public markets feeling crowded isn't often a decision maker for a lot of people searching private equity. Also, people searching for capital differentiation. Any thoughts on that one, Tim?
Yeah, I think it's worth, sharing a little analogy, a little insight. You've heard of the term the S&P 500. So, the S&P 500 is just the biggest 500 companies in the United States. But those are the biggest 500 companies that are publicly traded in the United States. And you may have heard of the Magnificent Seven. Those are the biggest 7 companies out of that 500 that are having a significant impact on the movement of the S&P 500. They actually represent about 35% of the S&P 500 is just what's going on in those biggest 7 companies. Things like Apple, Amazon, so on, Meta. These are the big 7, the Magnificent Seven. You can Google it or ChatGPT it or Perplexity it or whatever you want to look up. But point is, you can learn about the Magnificent Seven, the impact they're having. If the statistic that I shared with you previously is true, which again, I'm not 100%, you should double check it, as to what percentage of the United States companies are publicly traded versus privately owned. If that is true, that only 13 to 15%, let's say, are publicly traded, then that means 85 to 87% are privately owned. So imagine those biggest 500 companies that we're talking about that are everyday names that a lot of us are thinking about on a regular basis. If that only represents 13 to 15% of the actual significant companies that exist in the United States, then what we're saying is there are about 7 times as many companies as are in the S&P 500. There's about another 3,500 companies that you can't access to invest your money in, with everybody putting money into 401ks and 403bs and retirement accounts, IRAs, and then regular investments and normal investment accounts that you might use that are not in qualified plans. You're seeking more diversity. The analogy that comes to mind for me is it's kind of like back in the day when we had TV that only had a few channels on it. You had like channel 2 and channel 6, channel 8, and then maybe you were lucky enough to get channel 12, and there were like 4 channels. And now we have then you get cable, and cable gives you all kinds of channels, and now you have streaming services with almost an infinite amount of different shows and just a voracious appetite for coming up with new content that are out there. And yet all of us can get to the point where we feel like, oh, I've seen it all already, and I'm waiting for something good to come out. And that's where we are now with this 500 companies. These we've seen it all already, and there's another 3,500 out there that we're kind of interested in seeing if we can get our hands on, because we're kind of tired of the same old channels.
You're dating yourself a little bit with the 4 channels too, man, and the IBM comment.
Yeah.
I appreciate you sharing all that too.
How many channels were there when you were a kid?
That's a good question. I mean, you probably capped out at about 20-ish.
Yeah. Okay. Yeah. All right.
So
20.
not terribly different.
No,
and you had to watch the TV guide on the screen. It would scroll, and if you missed it, you're like, oh shoot, gotta wait for it to go back again.
Back in the day.
Exactly.
Well, you were just telling me about Limitless. You were talking to some of our guys.
That's a great movie.
And it is a great movie, but some of our newer guys, these Gen Z guys, haven't even seen some of the stuff. So Tyler's starting to feel old. He's getting a little bit of that going on. So
a couple of rays are coming in. It's a good time.
Welcome to my world, bro.
It's good to be here. So Tim and I talked about why it's gaining attention. I think some of those indicators are pretty clear as far as it's concerned. I'd like to talk about potential benefits, Tim, and then we can go into some of the real trade-offs and then wrap this thing up from there. So
sure.
Some of the potential benefits that most investors see as a pro, if you will, for using private equity. Tim already hit on it. Access to companies before an IPO. So initial public offering, IPO, gets thrown around. A lot of times that's for public companies that decide to trade their company on a stock exchange where you can buy it in a ready market. And usually it's a pretty fluid process of buying and selling their stock or their equity. Private equity, different. There's no ready market per se. You have to know somebody to kind of get into it. And that comes with a lot of trade-offs and potential opportunities for a portfolio and for an investor. One of the largest, non-correlation with other public markets. So a lot of the times we're looking for opportunities to diversify our assets, not putting all of our eggs in one basket, as everybody has said for many, many years now. And correlation comes along with that. Are your assets moving in line with one another? If one thing is down, is the rest of your stuff down too? Or if some of your stuff is down, is the other stuff up? Is kind of the general term of what correlation means. How do they move in synchrony with one another? So private equity can be a great way for looking for opportunities within that.
Yeah, it's a good diversifier, but I would say also, in the past, and I mean even now, there are rules, there's restrictions on investing in these. You have to be an accredited investor, so they're only available to certain types of investors. But they are getting to the point where they're becoming more accessible. I would say they're more accessible today than they ever have been before. You're starting to see newer ways that the general public can access some of these private equity investments and diversified portfolios that are available. It's still not as obviously liquid or commonly available as normally publicly traded companies are, but I would say the trend is going in this direction. And just because you have a privately owned company doesn't mean that you're looking to try to have an IPO. You might want to retain control in the private market and not have to deal with public, the public scrutiny that comes from having a publicly traded company. When you have a publicly traded company, the owners are the general public, and the general public can come in as owners and say, show me this and show me that and show me this and show me that. And I don't want you to buy lemons from this company. I want you to buy lemons from this company, and I think your sugar is bad and you should do this here. And then all of those arguments can filter in and can slow down the growth potentially of a company. And if a company wants to say, I don't want to deal with those arguments, I just want to be able to make my own decisions and control my own decisions, make my own decision on my lemons, make my own decision on my sugar, then they can say, hey, I'm going to stay in this private world for a long time, and you may not be able to ever participate in them unless you can figure out a way to access it with some of the new accessibility that's been coming out.
Yeah. And I think this podcast is not here to say private equity is the end-all be-all, or if it's for one person or the next. It's just to talk about, is it worth the hype, and kind of where does it maybe fit into a portfolio and a financial plan. That's what we do. We're here to evaluate all the investment opportunities that exist out there and see where they fit in as puzzle pieces to solve your puzzle at the end of the day.
Perfect.
Potential benefits, we talked about those. Some look at it as also looking for different differentiated returns in their portfolio. So let's talk about trade-offs, Tim. Illiquidity, we talked about that. That's a huge big one. You can't just stick your money in, get it out the next day. There's a lot of nuances associated with the illiquid nature of these investments. Valuation complexity is also difficult. If you own a publicly traded stock, you kind of know what it's worth at any point in time, any given day. Private equity is different. There's not somebody going out there and valuing the portfolio or valuing the specific company that the private equity owns on a daily basis.
Yep.
So there's less transparency with that stuff. And then, as many people are very conscious of, fees. So to get this access to these types of investments and this opportunity, if you will, a lot of the times it'll come with higher fee structure, or maybe not per se higher fee structure, but a different fee structure than what most people are normal or used to.
Yep.
Also worth mentioning.
There's nothing to add to that. I think those were all on point. I feel like we should probably bring it to just the answer for those people that want to go there, unless there's more thoughts that you have in mind. But I think it's not automatically better or more sophisticated. It's simply another tool. Yeah.
Is really what this podcast was meant for.
There are a lot of different ways to invest, and I think that too often people try to oversimplify things. They try to get it back to those 4 channels or 20 channels, depending on how old you are. And the reality is that's just not our world anymore. We don't have just 500 companies to invest in with the S&P 500. The Russell 3000 is 3,000 of the biggest companies. That's massive, and those are still all publicly traded. So when you're focusing on the private ones and you're realizing that you're only tapping into 1/7 of the market with the publicly traded stuff, there's a whole universe out there that you probably didn't even know about. And we have to learn about all that stuff, go through the pros, cons, break it down for our clients so that they understand what their options are, and ultimately they look to us to say, okay, I get it. You've looked at the whole world in a bigger way than we've looked at it. Now what do you think we should do? And that's where we give you personalized advice along those lines. And, happy to have chosen and found this profession at 21, almost 29 years ago.
Nice.
It's crazy. I've been doing this for coming up on 30 years.
That's so cool. I think a good quote that resonates with me with this type of investment strategy or any alternative type of investment strategy than what is pretty Main Street is complex is not always superior when it comes to investing. A good rule of thumb is if you can't explain to your mother how the investment works and the trade-offs and the pros and the cons, it probably doesn't make sense to have it be a large part of your portfolio, maybe a small part. But usually you want to understand it at your core and be able to explain it to somebody else in order to justify if it's maybe a right fit for you or not.
Yep. Don't even get me started on cryptocurrency. But, yeah.
We'll save that for another one.
Yeah, that'll be another one.
Yeah. Let's adjust the answer, Tim.
Sure.
Sound good?
Yeah, sounds great.
Our topic of the day was, is private... No, that's not the topic of the day. Topic of the day was, is private equity worth the hype? So Tim and I talked about a few key things here. We talked about what private equity is. Just for the listeners and just the answer here, it's investing in companies that are not publicly traded. Instead of buying shares on a stock exchange, your investors are pulling capital into private funds that acquire or invest in businesses, often holding them for several years before trying to resell at a profit. We also talked about some of the trade-offs. The biggest trade-off is liquidity, lack of a ready market. There's also less transparency and often higher fees. In exchange for those things, investors are looking for differentiated returns, maybe reduced correlation to public markets, as well as other pros and cons associated with the investments. Mm-hmm. Tim, maybe you'd like to share a scenario where it might make sense for an investor to consider this.
Yeah, I would say just the answer. In general, I do think that this is the kind of, it takes a sophisticated investor, usually with a little bit more income, a little higher net worth than the average investor, and they're usually looking at a percentage of their portfolio that they want to have in private equity, and it could be anywhere from maybe 0 to 20% or so. It's rare that we would see much higher than that. But a lot of the endowments, a lot of the big charities that are out there use a significant portion of their portfolio to invest in private equity. I mean, they've seen the performance associated with that. They have access to certain things that a lot of typical investors just don't. And it's a good scenario when you're working with ultra high net worth individuals or high net worth individuals. Say those are the ones who are most likely to want to have a piece of their portfolio exposed to private equity for diversification, and they can afford the lack of liquidity because they have enough other resources that they're not dependent on that private equity position. If you're dependent on that private equity position, if you need access to that money, it's probably not the right fit for you.
Well said. All right.
Cool.
Ready for some trivia?
Sure. Hit me with it. What you got?
Okay. Tim, I'd like you to tell me, which company was once privately owned for over 30 years before going public and becoming one of the largest IPOs in history? I got options for you.
Do you? I'm curious. The one that comes to mind for me before you have the options. I feel like Warren Buffett's Berkshire Hathaway is probably a big one. I don't know how long it was private before it went public and the implications associated with it, but that's kind of one. There's a lot of big success stories with private equity and going into IPO. So go ahead and hit me with your choices, and if that's not one of them, then clearly it's not the right answer.
Tim, your first option is Facebook, also known as Meta these days.
Got it.
Option 2 is Visa. Option 3 is Uber. Option 4 is Alibaba.
Okay, all right, cool. So not Berkshire Hathaway. I wonder how long that was private before it went public.
That's a good question.
Yeah, I mean, 30 years is unique. So when you think about Facebook Meta, clearly it's not Facebook Meta because Facebook came out less than 30 years ago. So it can't be private equity for 30 years and then go public. Let's see, Uber, same thing. It wasn't private long enough. Actually, is Uber public yet? I don't even know if it's public yet. So anyway, point is it hasn't been around 30 years, so that's not eligible either. Alibaba and what was the other choice?
Visa.
I could see Visa. That's old enough as a brand. I mean, it's possible Alibaba, but I still think that's still too new. I'm going to go with Visa.
It is not. It is Alibaba.
Alibaba.
I liked your sequence of reduction there with Facebook and Uber. I thought that was really good.
Yeah.
So my optional, my tie back here to the podcast is private companies can grow very large before ever becoming public, which is part of why private equity generates so much interest.
Yeah, there you go.
Yeah.
Being interest in private equity, not necessarily interest as a rate of return.
Correct.
To be abundantly clear.
Yes.
But I'm pumped. Yeah. Thank you so much for joining us on Clear Money Talk, and we hope hope you continue to hit the subscribe button, continue to join us for all of these educational, insightful moments as we make complicated stuff more practical and actionable for you. And of course, if you're looking for another opinion or another insight or seeking a financial advisor, that's what we do. Happy to chat with you as well on a Clarity call.
Yeah, we appreciate your time. If you found value in this episode, please consider subscribing, sharing it with a loved one, and we look forward to seeing you on the next one.
Until next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for informational purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Cetera Wealth Services exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. A diversified portfolio does not assure a profit or protect against loss in a declining market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Cetera does not offer any direct investments, endorsements, or advice as it relates to Bitcoin or any other cryptocurrency. This is for informational purposes only. Private equity investments are speculative and involve significant risks, including the potential loss of all invested capital. These investments are typically illiquid, may require a long-term commitment, and are not suitable for all investors. Returns are not guaranteed and may be affected by leverage, market conditions, valuation uncertainty, limited transparency, and higher fees and expenses. Past performance is not indicative of future results. The Russell 3000 Index is a market capitalization weighted benchmark that measures the performance of the 3,000 largest publicly traded U.S. companies, representing approximately 98% of the investable U.S. equity market. It is reconstituted annually to include new companies and remove those that no longer meet capitalization or liquidity requirements. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.